Well, welcome back to Bullish, everybody. I am Sam Hardy, joined as always by Nick Stenger. We are Stenger Family Office. For the past 42 years, it has been our mission to deliver both clarity and confidence to help secure your financial future. We apologize for the brief hiatus, but we're back. We're better than ever. We had an awesome event a couple weeks ago, our Investor Day event. If you missed it, be sure to look out for the recordings. Nick is getting those out. And for those that did show up, thank you. We really appreciate it. Now, we got a revamped show. We got episode number 10 here. We got producer Owen in the back.
Producer Owen in the house.
He's in the house.
And I'm hanging out with the Hardy boys.
Yeah, it is the Hardy boys. Producer Owen is, in fact, my younger brother. We're very excited to have him here with us.
Owen.
And before we get into it, I just want to talk real quick. Anything that we talk about, not individual stock advice, past performance, not a guarantee of future results. Stenger Family Office and its clients may hold positions in some of the stocks discussed. For a full disclosure, visit StengerFamilyOffice.com. Okay, we're back at it here. I can't tell you how nice it is to not be sitting in an office. Yeah, we get to hang out. We get to talk. We're going to be, again, revamped show. We're talking some what's going on.
There were a couple what's happening where I was talking, going through a chart, and I saw you visibly falling asleep on a couple episodes. So.
Well, I mean, that's not true. And if you're going to call me out on something like that, I'm going to go ahead and say there were a couple times where I know for a fact you weren't looking at anything for the show. You were replying to an email or something like that. Like, Nick, you there? What's going on?
Well, this is better. This is better. This is like Monday meeting with 2 less people. So it's close.
Yeah.
It's close.
Yeah. And, I don't like talking at all. In fact, it makes me a little uncomfortable, but okay, that's enough of the small talk. Let's get into it here. First one that we're talking about, we got Sam Altman.
I think you should explain the new structure for both.
Well, I was going there and then you interrupted me.
Sorry. Okay. I'm sorry.
All right. Okay. So sorry. But we're going through counseling right now. We're working through a couple of things, so it's all right. But no. The first thing we got. So we're going to be covering, what happened during the week. Let's talk about some articles. Then let's pull up some charts. We got some great people that we follow, that we pay attention to. Want to give them the credit they deserve.
Top charts of the week.
Yep. Top charts of the week. We got L of the week, who's been making some calls that aren't the best, that we don't want to, throw them completely under the bus, but we want to bring some attention to it.
If you're not aware of what an L is, it's somebody who has posted something probably about a year ago, I think is our time frame, right?
Yeah.
We're going back about a year. And now, look,
it could be recurring L.
We aren't making fun of them, but we are saying they got it wrong. And it's mostly just people that were bearish. That's really what it is.
Yeah. Yeah. Bear of the week, L of the week, similar thing. Maybe we'll pull up a meme here or there, and then zero or to the moon.
Yes.
That'll be a fun one. Part. Yeah. That'll be a good one.
We will cover earnings from time to time.
Well, yeah, part of the articles might be talking through some earnings. Like this week we've got Nvidia, but and talking some big names, some big players, some of the biggest, the best companies. So this week we're talking Nvidia. We got them later. So that's the new structure. We're really excited about it. Looking forward to it. And with that, am I allowed to get into the first topic now?
Ahead.
Okay.
Yeah.
All right. So let's talk Sam Altman. This was actually 2 Fridays ago. He got canned out of the blue by the board at OpenAI, and then 5 days later was back in place as a CEO. However, in the interim, there was an interim CEO over at OpenAI. Sam was then over at Microsoft. You had potentially the whole entire team at OpenAI say, well, we'll quit and we'll leave if you don't bring Sam back. So there's a whole lot of things going on there, lots to keep track of. I think it's settled down at this point, but certainly some things to be talking about there. So I don't know, share your initial thoughts with us, Nick. What stood out to you most from that situation?
Yeah, I mean, the whole AI thing is pretty interesting. I did say, maybe this is my L of the week, but I did say a couple episodes ago that I didn't think AI was going to be a massive deal. And I still hold that opinion. I'm going to stick with that. And the reason why is because a lot of the stuff, and we've talked about this week in and week out, whether it's Monday meeting, my show, Bullish, whatever it is, a lot of this has been done for 10 years now. Machine learning.
Yep.
Even artificial intelligence, robotics, process automation, all that stuff. And I'm not saying it's not going to have a bigger role in our economy where there is a 3.7% unemployment rate. That's why people are talking about it right now.
Yeah.
Is they need help replacing workers. So that's why it's a huge topic. But I don't think you want to go overboard on this idea that it's going to completely fix S&P earnings overnight. I mean, if you look at these big Fortune 500 companies, they literally haven't even done stuff that they could have been doing 5, 6, 7 years ago, just basic process automation, using cloud. Like half these companies aren't even on the cloud yet. So before we leapfrog to AI is step 9 or 10 out of 10, or maybe, I don't know, maybe it's step 8. I don't know. I'm not a technology expert, but it's definitely further down the road than just some of the basics that these companies need to do. They need to get on the cloud. They need to go towards, like, half these companies, you sign contracts on paper still. It's insane.
Yeah. Well, and everything's, I mean, even I know Chris and we joke about this too, and we're talking companies here, but I mean, our government is still doing stuff on paper. They don't have anything online. They don't have any automated. We were talking about it from a tax perspective where it's like, oh, well, the government's trying to do this and that. Chris is like, they still have people. They say it's an automatic process. It's a PDF that gets submitted that somebody sits there and scrolls through. Yes. It's not.
Well, that may be by design. So created by the people who do that job.
Yeah. Well, but anyway, I mean, to your point, right? Is AI worth all the hype? I mean, certainly there's been lots of companies that we've seen benefit from it from an earnings perspective or from a stock price perspective, from a forward looking basis. But everybody thinks that their job's going to be completely, wiped out. And are there going to be some? Absolutely. My favorite word. But you also have to keep in mind, how many jobs is it going to create, or are there going to be different roles kind of coming out of that, people adjusting what they're doing. So definitely something.
I heard a really good quote about this, how, in ESG, they do something called greenwashing, where a company pretends to be green or, environmentally friendly. They're not necessarily, they just use the buzzwords. So I think this isn't my quote. This was somebody I heard said, there's a similar thing going on with AI with companies, where a lot of companies are AI washing or tech washing, where they're saying, oh, we're an AI company. No, you're not really an AI company. You're really doing a lot of things, again, that have existed for 5 or 10 years. Now, getting into OpenAI, because you asked about Sam Altman, my thoughts on that. I don't think it's that huge of a deal. This news is going to come and go very quickly. He's back. OpenAI is, I believe they're a nonprofit is how they're set up. But one of the biggest problems that came up early on was he doesn't really own any OpenAI stock. I think that was actually talked about as one of the biggest issues. At the beginning, the investor said, hey, like, we don't necessarily want to be in a company if the CEO doesn't own any of the stock himself, and that was just by design. I don't know why that is exactly. Mm-hmm. Then I saw a funny, it was a meme, I guess, of the board of OpenAI. It was a joke. Yeah. And the board was just a bunch of robots sitting around the did you see that?
No, I didn't see it.
Around the conference table. So I don't know. Look, he's back. There's probably something like every tech company where they like kick the founder out and they realize they don't know anything, so they have to bring him back, like Steve Jobs, for example.
Well, but I think the only thing, and this will be my pushback on that, and maybe the difference here versus some of these other kind of tech companies, things in the past, you bring up Steve, he left. Apple did, they did fine, right? But they didn't really grow like they did when he was at the head.
Well, they almost went under without it.
Oh, okay. So I take back my statement. But this is what I'll say is, and this is why Microsoft got so involved, because Microsoft, I think they've got a 50% stake in OpenAI now. And so, they're the first, what is it, like GPT-4, it's the platform that they base everything off of. Now you've got all of these other companies that are building some of their processes off of that AI platform. And all of a sudden, if you have it disband, it would take some time to rebuild that. Even if you took away, it's Alex. He was just on Compound with those guys. I can't think of his last name right now, but he was talking about.
Is it No,
I don't know him. That's a different guy. But this is the guy. He does all the tech stuff. Right. That's kind of what he reports on his podcast. I was listening again to some of his stuff this morning, and it's not just like something that you can transfer. And Microsoft has been building out their kind of some of their AI stuff off of that platform. And it's like, well, okay, well, if this goes under, what's the plan? Do we have to build our own? What does that look like? So the only thing, and this is what a lot of people have been talking about, is OpenAI had kind of been really strong up until this point, and now there's a couple chinks in the armor. Is it an opportunity for other people to catch up a little bit, or kind of now start entering into that space where they don't have as much of, I'm not going to say it's not really a monopoly, but in a way it kind of is. Like you talk about AI, you talk about open AI and chat GPT. Those are like the buzzwords that you talk on or speak on.
Yeah, it's one of those things, and I think you get into an interesting point where you say it may not necessarily remove jobs. It's definitely in the short term, it's going to remove jobs. There's no question about it.
Mhm.
There's some jobs that will be displaced by OpenAI, but for everybody listening, I would not rush to this immediate conclusion, doom and gloom scenario that everybody's out of a job. In fact, I think it's exactly what you said. If you look at the tech bubble, so from the height of the tech bubble in 2000 till today, we had about 5 million unfilled jobs in the height of the tech bubble. Actually, about 4 million unfilled jobs. Not all of them were, great paying or the best jobs, but we had them nonetheless.
Mm-hmm.
During COVID, the peak of COVID, 2021, we had 7 million. Think about what's happened the past 23 years with cloud, robotics, high speed computing, you name it. Now AI, right? All these different things that have come up. We have almost double the unfilled jobs that we had 23 years ago. So it's not that these jobs get replaced. In fact, what they do is they lead to more explosion in wealth creation and better jobs for people that move on. Now, there's obviously a huge thing with learning, right? Retraining. That's the thing that everybody talks about. So look, I'm not here to say that AI is not going to cause any pain. It's not going to cause any problems. It will. In the short term, it definitely will. And retraining isn't just, take all these people who are doing X job and then retrain them overnight to do Y job, right? It doesn't work that way. It takes time. There's definitely going to be a transition point. But I think the general consensus that believes this doom and gloom narrative that AI is going to wipe out tons and tons of jobs and it's this new, it's not. It's a long process before that happens. And there's going to be a lot of wealth creation that happens along the way. So,
yeah. Well,
I don't know what your thoughts are on that, but
this will be the last thing I have to say about it, and it's coming from Elon, who obviously is involved. I know he's trying to implement AI into X and use kind of X almost as like a data hub to some extent for the AI. It's what Grok or whatever it's called that he's doing.
It's ChatGPT with an attitude.
Yeah, exactly. But what he said is, well, and now the board they've dropped 3 of the 4 people that were responsible for Altman going, but what did they find out? What did they see? Everybody's not even like from a job perspective. We're talking about robots taking over the world kind of thing. So it's, if you go and you take a look at it, what did they discover? What came up? And maybe this is a little conspiracy because I don't think there's actually anything that's been said yet, but I mean, that's where he's coming in. He's like, well, what scary thing did they figure out? He's always been a little cautious on the AI side of things too, where, hey, what can we kind of do to make sure that this doesn't get out of hand?
Well,
is it right. Like I Am Legend? Is that the movie that we're, or iRobot? iRobot.
There's a lot of movies that alluded to this over time, but no, he's exactly right. You're exactly correct to bring this up. There is an ethical component with AI that has to be watched. And thank goodness we have somebody like Elon who's sort of the vanguard of saying, hey, slow down a second. Let's make sure we got the ethics correct first before we go full boat into something that we really have not explored yet. So I think you're exactly right. But then the other thing that Elon brought up is you said, beware of those who want to be AI gods. Did you see that quote?
So I didn't see that.
So that's a quote from Elon. Beware I'm paraphrasing, but it's beware those who want to be AI gods. And what he's talking about is there are people who literally say, if we have AI built into our brain, so like those Neuralink chips and all the rest of it, and you have almost like this, I guess it's like a human technology combination.
Yeah,
it's almost like a human tech hybrid, I guess. This is a real thing.
Which it's funny he's saying it because he's the one that's coming out with Neuralink.
Right.
But continue.
So there's a question of, does Elon, is he in a winner take all type of deal where he just wants to be the one that everybody uses, and then it's he basically he beats everybody else? Maybe he beats Google, he beats Facebook, all the other companies. But I think there is a level of it where he really does care. I think he really does care about the impact of this stuff. Because there's these people who at the World Economic Forum, the UN, who they would love to be AI gods. And I know this sounds crazy, but that's how they really see it. If you watch their videos, you watch their presentations, the scientists, all the doctors, all these people, they would love the opportunity to really have this godlike power. And that's where Elon says, like, hold on a second. Like, just wait for a little bit and just make sure everything's sort of worked out. And let's give this technology to everybody as well, all the rest of the people. So it's not just this massive power concentrated in a few hands. So he's bringing up a good point.
Yeah, no, I mean, it is interesting to think about. We'll just have to kind of see how that goes along and if we actually get a reasoning for why he was fired in the first place.
One question for you. We're all in the service business, right?
Yep.
And relationship business. Do you see it replacing your day-to-day? I don't think so.
No, and I mean, we talked about this at Investor Day. We did the panel. And we talked about this, and you go through, and now this is one from a tax perspective. Chris is like, yeah, it's great. It makes the actual, the doing the returns part of it easier. It definitely helps out, which means I just have more time to help with the planning side of things, which maybe AI will be able to help out, but they're not going to be able to talk a client through that. I mean, yeah, things are good in the market right now. There's doom and gloom everywhere that you look, but do you foresee yourself being replaced by a robot and I guess I'm turning the question over, but do you see somebody going to a robot instead of you and going, oh, well, all these things are happening and the robot, there was something, it was during, I think, the COVID crash, actually, where there was robotic trading that was happening, and it saw like certain triggers, and it was like some downturns were almost worse because the robots started trading on that. And so, I mean, you don't want just robots doing everything for you. And from a relationship standpoint, you can't have an emotional, conversation. They don't know the whole story. They don't know the full plan. They're not going to be able to provide that kind of emotional intelligence, the EQ that's necessary in our line of work, at least.
Well, there was Steve Wozniak. He was one of the founders of Apple. I mean, one of the early Apple guys, right? Yep. He basically said the best AI, and I know things will improve over time, but he said the best AI still isn't as smart as an ant's brain. That's wild to think about. Ants are pretty smart, but even the best AI still can't beat an ant's brain. So I think what happens is there's a knowledge component, and then there's a wisdom component of every decision. It's like, okay, this is the knowledge, this is the math equation, this is the algorithm, but here's the actual application, and that's where I think AI will struggle. And I see, even robotics, right? Like you look at the Flippy and the Dippy at McDonald's, the robots flipping burgers. It still hasn't created a massive shortage of or a massive layoff problem for McDonald's. In fact, almost every McDonald's you go past says now hiring.
Yeah.
Right. So there's always going to be people, but I think that it's actually as human beings, we should want this to happen. We should want more technology because it makes lives better. It makes jobs better. It creates wealth. And then you look at it and you go, what were the original settlers doing who came? Think about this. The people that came over from England, right, to settle in the United States.
Yeah.
The Pilgrims.
Yeah.
They were living till maybe 35 years old. They were dying from hypothermia, from starvation. They
get a fever, gets a little out of hand.
Yeah.
Nothing to take care of it.
Yeah. And think about the advancement in technology from then till now. Yeah. It's like life has gotten better, and I think a lot of people, they just always operate in this doom and gloom environment where any change comes and they just immediately think it's gonna be the worst thing ever, but the reality is things have always changed. That's the one constant. So I think in the end, things are going to be just fine. I tend to be an optimist, but I do think Elon's right to raise the concern about ethics. So.
Yeah, sure. There are some concerns there, but let's talk about change. Let's talk about change in the bills that's hitting governments now. So $2 trillion in interest that's going to be hitting governments across the globe. If we look at this chart, right, it's a 10% increase from next year. Projections have it at $3 trillion. Come 2027, so 5 years there. I mean, so a lot. The U.S. itself makes up a third of that, per this article from the Wall Street Journal, and so it's definitely just something to keep in mind as this becomes a bigger part of the United States fiscal budget each year. What do we need to be keeping an eye out for? Do they raise taxes? Do we think they could cut spending in areas? I mean, I'm sure you've got some thoughts on that.
Yeah, this is a real problem. The fact of the matter here is the U.S. Okay, so this article at Wall Street Journal says the U.S. accounts for about a third of the global interest payments on government debt.
Yep.
I think we're quickly approaching $1 trillion a year in interest payments. Is that correct?
That's what next year it's supposed to be $700 billion roughly, but Yeah, I mean, it's certainly something that people are keeping in mind.
If you go to Fred and pull up U.S. debt service, I think it's even higher than that.
Well, I know everybody was throwing around $1 trillion this year.
Yeah, we're quickly approaching $1 trillion. So I think the bottom line is what's the entire U.S. budget now? So if you pull up the annual budget,
6.3 or 6.1 trillion.
Okay, so
in 2022.
All right, so let's say, and I think next year it's estimated to be 6.3. So let's say debt payment is $1 trillion. That's 16% of the annual budget is going towards paying off our interest, not even the principal, the interest on our debt.
Mm-hmm.
So I go back to this reality that this is not an accident, and everybody talks about this and they say, oh, what are we going to do? We're in this complete federal debt mess. Like we have too much debt. And I do think there's part of that where it is true that debt is going to be a future problem. I don't think it's a tomorrow problem. It's not we have this massive issue where if we don't pay it off right this second, we're going bankrupt. I think those fears are unfounded. That's a lot of the guys who are trying to sell gold and silver. You see what I'm talking. I'm talking about. The guys, pitching annuities and all that nonsense. They're going out to our clients and saying, "Listen, the government's in a real problem. We're going to default on our debt. You need to buy gold." And I'm like, if the U.S. government defaults on their debt, gold's not going to get you very far. Like you're not going to go down to Jewel-Osco, to the local grocery store or Costco, and pick out a bag of groceries and then hand them a gold bar. It doesn't work like that. So you just have to say, okay, the debt problem is a future problem if our income cannot support the debt payments. U.S. GDP is still $26 trillion, right? On a nominal basis.
Yep.
U.S. household net worth is 120. I said billion, I meant trillion. U.S. household net worth is 126 trillion. Did you know that?
I did not know. I wouldn't have thought it was that much.
Think about that. So U.S. GDP is only 26 trillion. Okay. Household net worth is 4 or 5 times higher than that.
Yep.
So the reality is we have enough assets to support the debt we have. The question is going to become, do we have enough income to pay the debt? And I think the answer for now is yes, but it should be a warning long-term to policymakers that if we don't get this problem under control at some point in time, it doesn't have to be right. I would love it to be next year or this second. It's not going to happen. But if we don't get it under control at some point, we will have a serious problem. That's just the reality. And I think take it even a step further and say, every single time we've been in a position like this, and we've been in positions like this in U.S. history, probably 3-4 times. We've been in the 60s, right? Coming out of the LBJ years, the Great Society, print and spend, the Jimmy Carter years. And what we've done every single time is we've paid the debt off. Policymakers don't do it until it gets really painful and they have to wait till the last second. And if they don't do it and they have to raise taxes or inflation keeps going up, they get voted out of office. That's really what it takes. But they will do it. We will pay the debt off. Look, it's not something to panic about. I don't think this is something that you should stay up late at night, stocking your bunker full of canned food and gold and guns. I mean, knock yourself out. If that's really what you want to do, go for it. But I don't think this is an immediate concern. In fact, I think what's really happened is it causes a bigger question of who's really the new banking system in the world.
Yep.
And I don't think people really give this any thought. And I'm not saying, Apple's a bank. I'm not saying Berkshire Hathaway is a bank in the traditional sense.
But they're sitting on a lot of cash.
They've got more assets on their balance sheet than most regional banks would have. I mean, we could pull up how much in deposits PNC would have, which is a pretty big size regional bank.
Well, and I'll just say while you're looking that up, Berkshire, they had what? 157 billion?
165 billion.
165 billion. And think about they're, clipping 5% on that right now on the short-term treasury front.
So PNC is sitting on 436 billion in deposits, and Berkshire has 165 billion dollars just in cash, not even assets.
Yeah, and PNC is a bigger regional bank.
Yeah, PNC is a $51 billion bank even after the most recent correction. So I think really where the world is going is companies have really become more wealthy than governments by a long shot. In tech companies, large Fortune 500s in particular that have managed well, they've saved for a rainy day, they're sitting on the big cash pile.
Yep.
They're in a better position than most banks are.
Well, and interest rates don't affect them right now. They don't need to go out and borrow. If they really have to do something, they're sitting on it. But right now, they can get free money.
Yep.
And so they're just, they when rates were zero, they borrowed because it was free then. Now they're sitting on all this cash and they can just sit and collect 4.5%, 5% on interest now. And they are.
Well, I'll take it one step further, and I'll say this: that I don't think the U.S. is gonna go out of existence. Okay, I don't think that. And there's a lot of people that believe that, especially the same people that are pitching the gold and silver that say the U.S. is gonna go under and all this stuff. And they go back to the Roman Empire only lasted for X amount of years, and the U.S. is past that. So it's like our time, like it's up, like we're ready to go out of business, just like the
like that's a good thing. Like I told you guys, I wanted our country to fail. You're like, oh yeah, thanks buddy, it really helpful, really helps us all.
And I don't even think they're right.
No,
I don't think they're even close to being right. One thing I will say is China, for example, China could seriously have some actual problems, and let's just say China ceases to exist. What happens to U.S. companies if China goes under? It's a little blip on the radar. Companies with more Chinese exposure obviously have trouble, right?
Yeah.
Like McDonald's and Starbucks.
But you lose all the revenue from over there.
You lose a lot temporarily.
Yeah.
It doesn't go away completely, but then China rebuilds. It comes back and the companies are fine. And now I'm not saying China itself rebuilds. It's obviously whatever happens, with the remainder of it. But my larger point is companies are more powerful than governments. And that's why the governments have been pounding the table for so long to do what? Increase taxes, antitrust, like in Europe, that's a huge deal.
Yeah.
China just says, you come into our company, we take all your IP. We take all your trade secrets.
Yeah.
Why? Because they know they're not in a position of strength.
Well, and we've even talked about Disney China. The CCP owns the majority of it.
60%.
Disney doesn't even, it's like,
Right.
something close to 60. They don't even own. Well, and that stock's done really well. So, but no, they do talk about this. Part of the issue with China too is you can't, they want to see everything that you have. If you're a company going in, they, like you said, your intellectual property, they want to see what you have. Well, guess what? They're not going to show you anything. Look at that. You don't know how much debt they have. Right. They actually talk about this, that, you can't track it. There's zero transparency
in this article, right?
Yeah. And, they just talk about the fact we don't really know where China's at. We hear about ghost cities and, what's their biggest real estate company
Evergrande?
That was it earlier this year. They were about to go out of business or file bankruptcy or something along those lines, where there's definitely some issues. And they said the biggest thing with the China is it's not how much debt they've taken on necessarily. It's how quickly they've taken it on. You've seen this massive growth over there, but they've had to borrow a lot to do it. And so that's kind of what's making it uncomfortable.
It's all been borrowed and printed.
Yeah.
Yeah. Well, and I think this gets into on the weekly show, I talk about this all the time, how printing money, which only happens thanks to the Federal Reserve.
Yep.
Is one of the 10 tenets of Marxism. It's one of the planks. Okay, why? Why do you need? And I would argue it's the most important one. And whether Karl Marx knew this or not, I think you can argue that central banking is the component of Marxism that lets it exist. It's literally the bedrock of it. Mm-hmm. And the reason why is because you cannot confiscate people's wealth any easier than printing money into existence. You tell somebody your dollar in 1920, the dollar today is now worth 19 cents in the 20s. That's wealth confiscation at the highest level. The government does not, and this is what people don't realize, the doom and gloomers and the preppers and all the doomsday people who have the bunker. Like, the government doesn't have to walk into your house with guns pointed at you to take your money away. They can. I mean, they've obviously done this in the past. They do this in China on a regular basis. They don't really have to, though. All they have to do is deflate your currency.
Yeah, and lower your purchasing power till it's non-existent.
Yes. So if you want to redistribute wealth, you're a politician, okay? And I'm not talking just Democrats. I'm not talking just Republicans. Both of them together have done this. They've colluded together. And what they've done, and by the way, they're both responsible for this $2 trillion in interest bill that you're talking about, right? Mm-hmm. They're both responsible for this. if you get them together, okay, and you look at their policies, and I'm not talking the fringe, I'm not talking like Bernie Sanders. I'm not necessarily talking, whoever would be the furthest right in Congress, but I'm talking about the majority, the people in the middle, the speaker, on both sides of the aisle.
Yep.
Their policies are basically the same. They may differ a little bit socially. They may have little, different differences in like how they go about things. But at the end of the day, what do they all do? They all print a ton of money. They get us into endless wars. Okay.
Yeah.
Okay. All the stuff that, I think most Americans would argue against the fact that we send so much money overseas, yet we have massive homeless problems and poverty problems in the U.S. All of the issues that you would think there should be some debate in Congress.
And they've got some of the best investors as well. Don't forget about that.
Well, talking about Twitter, I mean, what's the account that follows Nancy Pelosi? Is it literally Nancy Pelosi?
I think Nancy Pelosi stock tracker.
Tracker.
See if I can.
And by the way, I will say this isn't just Nancy Pelosi. It exists on both sides.
No, but she's the most famous for how much does she have? Like, what's her net worth at this point?
Well, if you go to the accounts Unusual Whales, they track both sides. So they'll track the Democrats and the Republicans.
Oh, they just had a great one. We don't have a chart for it this week, but we might have to pull it up for next week. We can go with that because there's one it talks about. It literally shows like the top traders,
right?
All in one chart.
I think if you scroll down, there.
Oh, it's right here. It's literally right here.
Yeah, pull it up. Can you zoom in at all?
Members of Congress. No, I can't. It leaves it. Members of Congress to beat SPY in 2022.
So if you're listening and you're not watching this, at the top of the list is a Republican, Patrick Fallon. He's up 51% in 2022. Debbie Schultz, a Democrat, up 51%. Susie Lee, a Democrat, up 21%. David Joyce, a Republican, up 14%. All the way down the list. Mitch McConnell actually lost 7% last year, which wasn't that bad. S&P was down 18.
Yeah.
So he's pretty good.
Oh, this is for 2022. I don't know if I said that. So that's not this year. This is last year. So remember, SPY was down 18% last year. And the top two in this were up 50%.
Right. Which could just be a coincidence.
One from each side. Yeah. I mean, he could have made some bets. Maybe he dumped it all in NVIDIA I guess that was this year. So it wouldn't even accounted for last year. But certainly. I mean,
if you or I did half the stuff that the Republicans and the Democrats do, we'd be locked up. We'd be in a federal penitentiary right now for insider trading.
Yeah.
So what they do, for everybody who's not aware of this, which I don't know if there's anybody not aware of this at this point, what they do is there's a bill about to be passed into law. Like we're going to invade Ukraine. Russia's going to invade Ukraine. There's going to be Israel, Hamas. There's going to be all these different things. Or there's going to be a chip bill that's passed into law.
Yep.
Democrats and Republicans magically, it turns out, bought defense contractors right before the Ukraine-Russia war.
I mean, maybe they just got lucky.
They may have. For everybody out there, we are not insinuating that they had any insider information. It was probably just a really good trade.
Yeah. Yeah. Very good timing on their part.
But I think it's important to point out it's both sides.
It's both sides. If you were watching and you could see it, it was up and down, red and blue, right? It basically alternating up and down. So certainly, and it's not everyone.
Right.
It's not like they all do it.
Well, this is where it gets into, you got to get past the left and the right politics. You have to, because their favorite thing is.
Well, and if this is where you started with this whole thing, if it comes down to having a central bank, we're all in trouble. It doesn't matter what side of the political aisle that you're on. Yep. If the government controls, and I can't remember the exact quote, I'll leave that to you from Rothschild back in the day. But if we have a central bank, we're all in trouble. Yep. Doesn't matter.
Yeah, great point. I mean, Rothschild said, I think it was the 17 or the 1800s, I care not who makes a country's laws as long as I control the money supply.
Yeah,
that's an actual quote. So you got it. Their favorite thing to do is to get us to hate each other. Whether you're far right, middle right, moderate right or moderate left, liberal, conservative, whatever you are, whatever spectrum of the political arena you're in. Okay. You've got to get past this. Oh, the enemy is the right. The enemy is the left. That's the distraction for what's going on with the central bank. The distraction is, oh, we're gonna do something and then talk about it on the news, and then that's what's gonna insinuate, oh, these people, I hate their opinion, and if you watch CNN, you end up hating one side. If you watch Fox, you hate the other side, and in the meantime, they're printing trillions of dollars.
Yeah,
they're printing your dollar is becoming worth less each and every year.
Well, and it all comes down to confirmation bias, right? I can go out and find anything that I want. We have so much content that's put out now, whether it's from actual news sites, whether it's on Twitter or X or all these different places. You've got all these independent reporters now. If I want to, I can think what I think, and I can go out there and I can find 100 different articles that back or charts that back my point. And at the end of the day, it only deepens that divide. It pulls us apart even more because I think I'm right and I can go find 100 other people that agree with me and vice versa.
Yeah.
And it's something to keep in mind. Confirmation bias is the biggest enemy on that.
Well, I think it goes back to the famous, divide and conquer, right? That's what it is. That's what they're looking to do. They want to get you to hate the other side. People that, by the way, if you go out and meet people randomly, just you talk to somebody on the streets of Chicago or New York or any city, Houston, Dallas, pick your city, and you start a conversation with somebody, 9 times out of 10, you're going to find something that you agree with. You're going to like the person. You're going to walk away as friends. There's going to be something that you take away and you say, hey, that was a really nice person, or I learned something. 9 times out of 10. They don't want you to think that. They want you to think because somebody looks different or acts different or comes from a different political background than you, that you should hate them. And that's insane because you're missing the broader point that our currency is being devalued. And then you have somebody, and look, it's not just Nancy Pelosi, but she obviously is the example here. Okay.
Well, she's the one that just gets talked about the most because she's had a couple last minute things that popped up.
You're making how much does a congressional person make? 200, 250, something like that?
I don't even think it's that. I think it's like 160 maybe.
And then magically after 40 years, they're worth $300 million.
Well, they're really good traders. Remember, hers isn't 300, but 115 million.
That one says 290.
Yeah, but I don't know what that is. Yahoo Finance, at least I trust more than this. Looks like a blog or something.
Okay, well the point is,
anyways,
is that something else is going on behind the scenes.
Yeah.
So
all right, well let's jump on then from here. I think
I think we beat the dead horse there.
Yeah, we'll keep an eye on it. Nvidia, China chip delay hurt the stock a little bit last week. I think it started to pop up a little bit at the beginning of this week, bouncing back a little. Yeah, it's up 63 bips today. But I mean, they clobbered earnings, absolutely blew it out of the water. Was some of that priced in? We always talk about this. The stock market is a forward-looking instrument, and yes, their earnings have been, or the stock performance has been crazy, but it was really primarily following that Q1 earnings report. Q2 and Q3, they've killed it. They've totally knocked it out of the water. 18 billion on the top line revenue. They've increased their earnings per share to over $3.50. But I mean, to some extent, it was priced in. I think the really interesting thing is going forward. What does it look like? Their revenue stream has totally shifted, right? They were gaming. Everybody was locked in their house. Computers, the gaming, this became some massive thing during COVID. That was their biggest segment, was the gaming. And now it's totally switched to the data centers. I think the data centers were like 75% of that revenue number.
Is that that's most of like the AI related stuff would fall into data center, I think, right?
Yeah. So half of the data center revenue comes from cloud infrastructure. I've got just this CNBC article kind of briefly talks about it, but half of that revenue, the $14 billion, comes from cloud infrastructure providers like Amazon and Azure. I can't remember who that is. Is that Microsoft or Microsoft, yeah. Right? So some of those is where a lot of those come from. But I mean, that's the big thing. That's where, because those new GPUs are $40,000 a piece, and NVIDIA's got AMD's their closest competitor right now,
and they're not even close.
No, well, I actually did a chart beforehand. If you want to look at
oh wow,
all-time performance, return from 1999, which was when NVIDIA came around. Nvidia's up almost 83,000%.
Wow.
AMD up 730% since 1999.
Well, that gets into, we always talk about how companies, the stock market's just not just a random thing, right? It's like actual companies that make it up. This is a great example of that. There is a difference between how companies are managed, their corporate strategy, and where they end up long term. 82,000% versus 728 for AMD. So, I would say I'm in the camp, and look, I could be wrong about this in the short term, but I really think NVIDIA could become the most valuable company in the S&P.
Well, everybody upped their estimates for the price up like
well over 600,
700, some 800. You look, there was another great tweet where it came out and just talked about Goldman, Bank of America, just all the JP Morgan, all the big players in the space who are talking about where the stock should be have upped their expectations to $600, $700, $800 for some of them.
Well, the big question, and I understand this, but the big question is that maybe the revenue and the earnings are not durable. Maybe it's just like a temporary boost because of this AI craze. But I think that's bad analysis. I think a lot of this is just in its early stages. Again, I go back to the Fortune 500 example where half these companies still haven't even gotten on the cloud yet.
Yeah.
So how many more years of revenue do we have in the pipeline? And then a reoccurring revenue on top of that, because that's really what this thing should be valued on. That's what it is valued on right now, is what are the future profits going to be worth? Because right now, let's say that earnings are durable. Let's assume that they're going to do $4 a quarter. That puts it at a forward price to earnings ratio of 30. You know who else has a forward PE of 30? Like half the other. I'll tell you.
Pull it up.
Google is at 26. I think Apple's
Close.
at 35. Microsoft's 35. Apple's at 31. So you can't say, and I think this gets into the broader point of there definitely are two camps of tech stocks. There's high octane, run up 15 times sales type of tech companies, and then they've made that COVID round trip back to being worth what they should be worth, which is not much, right?
Yeah.
If you don't have earnings and you don't have revenue, nothing exposes that, like 5.5% interest rates.
Yep.
Right. Then there's the NVIDIAs, the Apples, the Microsofts, the Netflixes, the Googles of the world, where it's a real company. And then I think people have lumped all these big tech companies together with the rest of tech. And they made the mistake of saying, well, all of tech is down, like Kathy Wood, right? Her fund.
Yeah. ARK had a tough year.
ARK is down
last year
75% from its all-time highs.
Yeah. ARKK. If we look at the 5-year, we'll just look at the max. From 156. From down 70%.
70% from the peak. Okay.
Yeah.
So, okay. And by the way, isn't their top holding Tesla? I think it is. Yeah. So ARK's top. Oh no, actually no, that's changed. So, well, that's interesting. So ARK's top holdings now are Coinbase. Did you know Coinbase is their top holding?
I did not know that.
Roku is number 2, which I never understood the Roku craze, but I guess people like it. Tesla is now number 3, so they rebalanced. Number 4 is Zoom, which we've talked about Zoom a little bit here and there. Number 5 is UiPath. So yeah. There's a huge difference, in my opinion, between Coinbase, UiPath, Roblox, Twilio, DraftKings. Those are some of the other holdings she's got, and some of these established tech names. And I know the argument's going to be, oh, well, maybe they become the next NVIDIA. It's like, well, maybe.
Well, she was on the compound that one time, and they were talking about how, she was buying NVIDIA back when nobody did. And maybe that's a good time. We can bring up the meme of the week here. Picture yourself. If you're cleaning your room, you open up a statement, 2009. You owned 10,000 shares of NVIDIA at $2 a piece that you sold to buy a car. It's not as bad as the guy who bought 2 pizzas with Bitcoin, but $4.8 million worth of stock back in the day, 20,000 back then.
Yeah. So if you're listening and not watching this is a video of Rick, right?
Yeah,
Rick. The Walking Dead.
Yep.
and he's reading a looks like a piece of paper of some sort of letter or something, and he's really depressed that he sold his Nvidia.
Yeah, it's a point of reflection. Has nothing to do with the pending doom of the world, in that fictional show. However, he wish he hadn't sold
And
because he'd be a millionaire now.
I would argue I know people who had 20,000 shares of Amazon and sold it in the tech crisis. Now it did go down 99%. So if you go, okay, so here's what's crazy. If you go back to the tech bubble, Amazon would trade roughly between $3 and $5 a share. That was the height of 1999, a little bit of 2000. Then all of a sudden it plummets. In 2002, it goes to 55 cents. And I think we can all kind of play. Oh, you've got it up. So we can all play Monday morning quarterback here and say,
50 cents.
Yeah, we could say, we would have bought more. It's like, no, you probably wouldn't have, because you would have thought Amazon's going to go out of business. I just saw, did you see the video of Jeff Bezos on The Tonight Show?
Oh,
where they're laughing at him for not having like any profit. Amazon was unprofitable, losing money.
Is this an old clip?
Yeah, an old clip. And
talk about a glow up.
Talk about an L of the week.
Well, what do you mean an L of the week? Why is that an L of the week?
Not buying Amazon for 50
Oh, well,
cents.
yeah. Wow.
2002.
Yeah, that is an L. That for sure is. However, still only up, basically 30,000%. Nvidia is still up 50,000% more.
So if you put $10,000 into Amazon in 2002 at 50 cents a share, you would now have almost $3 million. I don't want to ruin your week, but
you already did that, so and it's just Monday morning. Not even the snow could ruin my week, and then that just did. So thanks, Nick. All right, well, everybody, we hope you enjoyed the show. It was great.
Hang on a second. You would have had to hold through 08 and 09. So again, this is where it gets into, I think a lot of people say, oh, I would have held, but you buy that narrative, you sell, how many people do you think sold at that most recent dip right there? Amazon was, what was the peak there, Sam, on 2021?
182.
No, it went up 182. I think it was 185.
183, 184. Intraday, it might have been 185.
Okay. And, then it went down how much?
Went down 50%.
A lot of people sold.
Yeah, you get worried. I mean, and we talk about this. This goes back to that emotional piece of it, right? You get worried. You see your stock going down. And a lot of investors make the mistake of buying high and selling low. You have FOMO. It gets to a point where you want to buy. You're like, oh, well, I've missed out on this at this point. Buy. Then it goes down. You're like, all right, well, I guess I'm going to dump it, take the L. And then, I mean, over time, right? Good companies. This just comes down to buying good companies.
Well, people don't realize how quickly the reversals happen. So, like, have you ever seen that chart where it says if you miss the top, 5 days, the best 10 days or something like that, your return gets cut in half?
Yep.
But it doesn't take years. It literally can be weeks sometimes. So the stock can go down, let's just say 15, 20%. All it takes is for a couple of good weeks, 2-3 weeks, and then the entire year turns into a positive year. I don't think people realize that.
Well, we talked about this with, right? We talked about this with AutoZone for the last year, or here we can do year to date. You could have held it the whole entire year. And then when it got back down to, what was that? We look at the beginning of November there, end of October, you would have been down 0.5% for the year. So if you sold it, you said, oh no, I don't believe in this stock long term. You would have missed out on 8.5% the last month.
All within, what was the exact? So go to the bottom.
August 24th, it bottomed at $2,416 a share.
And then when did it peak? Just most recently. So
November 13th.
2 weeks?
Yeah, 2.5.
And there's some weekends in there too. So it was probably, you said 24th, right?
It was like 10 trading days probably.
Okay, so that close would have been Friday the 22nd, and then you had the last week of October, 2 weeks of November, so essentially 3 weeks of trading.
Yeah.
And if you sold it, you would have been down about 1%.
Yep.
If you held it, you'd be up about 9%.
Yep.
Wow. Yeah.
So I'm not even to mention that there were lower lows throughout the year, right?
Well, think about Nvidia too. I mean, if you go back to that chart, Sam. So, and I think this is really important to point out with especially these higher flying tech companies.
What do you want? 5 years?
Well, look, first of all, the bigger the PE ratio, the harder it's going to fall during a correction. So if the market goes down 15 or 20% on a stock like Nvidia in a declining market, what was the decline from the peak there to the trough to the bottom? About 65.
Yeah,
so
66.
Okay, so the market was down in that period. Let's just say 22%, right?
Yeah.
Nvidia is down almost 3 times as much.
Mm-hmm.
So a little over twice as much. So you have to be willing on a stock like this. Everybody looks at the long-term chart, that 5-year chart. They go, wow, I could be up 1,100%. Yeah, but like how many people actually held through that?
Yeah. Well, we joke all the time. You buy a stock and you're like, oh man, dude, I was in at the bottom. I love this stock. And then you look at it, you're like, holy cow, I could have been up 3,000% over a year. And then you look at each other and you're like, all right, let's be real. You were not going to hold that thing. You would have like 5x'd your money and been like, all right, I'm out of here. I'm getting to safety.
Well, I mean, that's a good point. Like, so what was the stock price at the low there? Yeah. It was Nvidia was 125 in October of 2022. So that was pretty much the low of the market. How many people sold on that first leg up? It went from 112 to went up 50%. You were up
50% in 6 weeks.
Yeah,
how many 30 trading days?
How many people sold? Everybody?
I bet a lot.
A good amount. And then how many people sold on the second leg? It went up
well, I mean, yeah, if you got out here or you bought at this bottom 150 and held it 42%.
Yep.
In a month again. This is insane.
And then you doubled your money. And then now if you would have held it though, you would have been up about 224%. Not even from the bottoms, from that second dip down.
Yeah.
So, again, this just goes into behavioral finance. You don't always want to sell a stock just because it's up. Obviously, do your rebalancing. Now, with Nvidia up to where it's up to about $482 a share right now. I think the question becomes, what do you do with the stock? I've actually had clients ask me this. They go, Nick, I've been holding, whatever, Nvidia, Apple, Amazon. It just gets back into what your goals are. And then I think what your risk tolerance is going to be, because at a certain point, we were buying Facebook at the end of last year for about 90, 92. I think our average cost basis for clients came out to about 98 a share. Facebook's at maybe 340 today, roughly.
Yeah.
But 340, yeah. If we did nothing with Facebook stock, we would have gone from a 3% weight in the portfolio to about 8.5% today. To me, that's too much. I think 8.5% in Facebook stock is a little rich. Now, do I maybe give up a little more upside? I think so. And I would say, I think actually Facebook, now I got to be careful with this. This is an investment advice. But in the portfolio, I do think Facebook will be a top performer for 2024. But how much risk exposure do you want to have to a company that's not an 8.5% weight in the S&P? So we always try to go back to the basics, go back to the S&P, say we don't want to have too much exposure and too much tracking error, just in case Facebook does have a down year. We're still going to get some exposure. We're still going to have 3-4% in it, but we don't necessarily need 8.5. So you do want to take some profit off the table. You do want to be systematic with it, but you don't want to just panic because it's down, of course. And you certainly don't want to be selling. I mean, how many people, I can tell you for a fact, when Facebook got down to $90, that was when we first started buying it, actually a little bit before.
Think about all the doom and gloom news that was coming out about it too.
People said Facebook was going to go under.
Yeah. You bet. Oh, they took this massive bet on
the metaverse.
On the metaverse, right? I mean, they rebranded to it, right? They took this massive bet on the metaverse and it didn't pay off.
By the way,
dude, I'm not even gonna. I can't even talk about it. I don't care about the metaverse.
I like Josh. Why am I blanking?
Josh Brown.
Josh Brown's
Downtown Josh Brown.
Downtown Josh Brown. Shout out. No, but I liked his quote about how his joke about how if Mark Zuckerberg wants to sell more glasses, he shouldn't be the one wearing them in public.
Yeah, that's dude. I mean, look at that guy. That guy's jacked now. Remember, he and
Yeah.
Elon were gonna fight.
Yeah, but he backed out. Did you see that?
Well, he got hurt.
He got hurt. Yeah. No, we love you, Mark Zuckerberg. You're great. You're great.
Yeah, we like you as much as Jerome Powell.
Little creepy looking.
Yeah. All right.
We made money on your stock. So
yeah. You want to talk about the last couple articles real quick? Then we'll run through some charts.
Hit them real quick.
All right. City layoffs. You've been saying this for a little while on your show now, right? City's 240,000 employees. They said they're going to cut roughly 10% of that. So 24,000 people coming up here. They're not the only company to be on the watch for layoffs, but I mean, part of it is they're trying to return to their roots. They kind of spread themselves out too thin. They've had this new CEO come in and she's kind of trying to bring things back. What's our core business? What do we need to be focused on? And so that's certainly something that they're going to be doing is now over the next year or so, I believe it was shedding, roughly 24,000. Now, to be fair, over the last 3 years, they'd added 40,000 positions. So
why?
I mean, they said it was part of it was they had to make some adjustments to like compliance and regulatory things and from a tech side.
Okay.
And so they brought on all these people to get all the systems up to date to where they needed to be. So they brought 40,000 people on for that. But now
are those the people they're firing? Some of the same, or is it legacy people?
Some of them, I believe, is what I read. But the biggest thing is, they grew really quick to try and account for some of those changes that were going to be needed. And now they're, they've got a lot of people they're getting rid of. I think I believe it was them. They got rid of 10% of their kind of VP level people. So it's not only, the people that were brought on to help with the tech side of things.
I mean, for Jane Fraser, the CEO of Citigroup, this is her last stand, right? Like if she doesn't turn it around now, she's out. She's out of a job. I mean, now being out of a job as a Wall Street CEO is not bad. You get a pretty nice golden parachute pay deal, but you cannot get around the fact. And now she took over, I think, February of 2021. So if you go back to February 2021, and I should have done this before, but the stock was $65. It's down 32% price return since she took over. If you go and look at JP Morgan, same time period, JP Morgan is up 10%. If you look at Morgan Stanley, February of 2021 till now, Morgan Stanley is up 4%. So I think this is the issue is in the weight class, she just has not performed. I mean, even for goodness sake, Wells Fargo since February 2021 is up 18%. So this is her last opportunity to turn it around. If she doesn't turn it around here, I'm not saying it's all her fault, but if she doesn't turn it around here, she's looking for a new job. So I think that's the reality of what you're dealing with. It pays a 5% dividend. I know we used to do this with the old format with Bullish and kind of talk about it, but look, as a 1% position, you're betting. That's kind of where I'm at, about a 1% position. You're betting on the turnaround story and you get paid a nice dividend to hold it. I'm still okay with that positioning. I'm fine to bet on the turnaround. I'm fine to bet on the dividend for now and get compensated for that. But unless they really, really are able to grow revenue, I think that's what it's always going to come down to with the banking story. It's going to be a dog. I think most of that's priced in. You made a great point before talking about NVIDIA, but I do think most of it's priced in here. I don't know if you can go, on a valuation standpoint, certainly the stock can go down, but from a valuation standpoint, I don't know how much lower you can go. It's trading for 7.5 times earnings. The forward is 7.4. The 5 years 9. So it doesn't have a whole lot lower from a valuation standpoint to go. And what's hilarious about this is Morningstar has it as a 5-star stock. So say what you will about Morningstar's star rating system. Sometimes it's a contraindicator. I would say in this case it may be. My prediction for this is you bounce around, you take your 5%, and not a whole lot of anything happens. How much? You said 24,000 layoffs? 10%?
Yeah, 10%.
All right. So let's say how much is there a projection on how much that's going to save? I'd say what, $3.5 billion maybe a year?
Here. They didn't have it in here.
Yeah, probably about 3.5 billion. And then, on a stock basis, what's the market cap on Citi? Can you pull that up?
65 or 85, sorry.
85 billion.
Yeah.
So let's just say that adds, I would say, best case scenario, maybe it maybe adds 8 billion in market cap. So I think you could see the stock rally after they get through this. But again, it's always long term. It's going to come down to the growth rate, and it's just not there. They're doing the same amount of revenue that they were in 2020. If we go back to Morningstar, I think will let us go back about 10 years here pretty easily. So yeah, total revenue listen to this, total revenue in 2013 for Citi was 77 billion. Guess what it is today? 77 billion.
I should have guessed that because you said it was the exact same as it was 3 years ago.
And then the earnings have grown. I mean, to their credit, they've grown earnings to $6.30, pretty much all through cutting the shares outstanding. So they've reduced shares outstanding by about a third. So that's how they boosted earnings per share. But it's not because the top line revenue growth is going up.
Yeah, they've been buying back, which to be fair, I think a lot of people have been doing that this past year too.
Now, I know you probably want to talk about this, so I'll let you jump in, but I was going to make a comment about layoffs in general. I do think next year is the year of layoffs.
Yeah, well, and I had hinted at this too, right? You've been talking about this some on your show, but it is something to be on the lookout for because all these corporations at the end of the day are going to have to do what they need to do to protect their bottom line. And Walgreens, and maybe I don't want to get into it too much here. Maybe we talk about it on the next show because we were looking at Walgreens last week and looking at their balance sheet and looking at cash and cash equivalents on hand and then the outstanding debt that they have. And then you sent me an article over the weekend that they were laying off 5% of their corporate staff. And so it's certainly something to keep an eye on, especially for some of these businesses that have been struggling. Because to protect the bottom line, what's one of the easiest ways that they can do it and cost savings that they can find? And it's unfortunately letting people go.
Yeah. Well, and you're making a great point. Again, anybody listening, don't hear us the wrong way. We're not rooting for this, but this is a reality of what companies do. We have lived through record low unemployment the past couple of years. Like 3.7% is insane. Yeah. You could easily, and I think really, I've done some math on this. I looked at it again over the weekend. I think we're probably looking at about a 1% uptick next year in unemployment. That's not recessionary. And I think this is where you have to really understand how the stock market works, because the doom and gloom stories next year are going to be, layoffs are here. That's going to trigger recession. It's going to be all this doom and gloom. The market's going to go down just because and by the way, I'm not even in the recession camp. I'm going to put out an article this week called Recession or No Recession. Sneak peek preview. I'm going to say no recession for next year. But my argument is that you could even have a recession next year. That doesn't mean the market goes down. Like it doesn't. I think people think they associate every single time there's a slowdown in GDP with an actual decline in the stock market. That's not necessarily the case. It doesn't always happen that way. Why? Because companies are doing very well, especially at the top. So if you look at large caps, U.S. large cap companies, they have more cash on their balance sheet than ever before. They're making 5.5% risk-free. Berkshire, right? $165 billion war chest in cash, earning nearly $9 billion in interest on their cash. That's more than the revenue of the largest mid-cap stock. Yep. So what do the large caps do? The large caps will reduce headcount. They will. Okay. So if you're at a large cap, this is a little bit of a preview. And if you've been watching the show, if you've been listening, we said this in April. We said this in April of 2023. So this won't even come as a surprise to you. Layoffs are coming. I see it on LinkedIn consistently. I mean, I'm sure you're seeing the post #layoffs, and we see it. We follow the hashtag because we want to see what's going on. But I will tell you, the layoffs are picking up. Now, the small cap layoffs, my opinion, next year are going to be massive because you're dealing with small cap companies that mismanaged, or they made a couple mistakes, thanks to the COVID lockdowns and all that stuff. Not 100% their fault, but a lot of them did make some bad errors. Okay. I think we can admit that. They overhired. Number two, they overstocked up on inventory. They are going to be forced to lay off next year. They have no choice. They went from a 2.5% or 3% revolving loan to either 10% or even worse, no financing at all.
Yeah.
There's not, I'm telling you, from an accounting standpoint or
Yeah.
from a corporate finance standpoint, there's not a whole lot of corporate projects where you can get an IRR higher than 10%. And so if you can't beat the cost of borrowing with your projects, what do? You trim back, right? You slow down, you don't hire. And so I think the culprit next year is you see a 1% tick up in unemployment. Not this massive spike, but you'll see a little bit of a tick up. I think we avoid recession because, again, there's so much cash on the balance sheet. There's so much ammo on the sidelines that hasn't been put in the market yet.
Yeah.
The large caps hold up the market.
Well, and we're not even we haven't even talked about tech, right?
Right.
The biggest names in tech, the FANG stocks, the Magnificent Seven, that everybody's saying, oh, 7 stocks are the only thing propping up this market. They're the only ones that are positive in the S&P. You know, like, see all these ridiculous tweets about it, which is, you know, far from the truth. Tech last year did terribly. The biggest stocks got smoked. They got destroyed. And then at the beginning of this year, they took cost-cutting measures. They laid off people.
Amazon,
Facebook, Amazon, not necessarily Google. You know, like, we saw a lot of tech layoffs this year because they were struggling, and it was a part of what they went through last year, right? So you almost saw it, and then they had a great year this year. So it's not that's an indicator of what's to come in all the other places, you know, exactly like that. But we did see that already kind of happen in tech, you know, last year and into this year. They struggled. Earnings weren't great. You know, the stocks did terribly, down 50% for some of the top ones, the top 7 names. And they took measures that they needed to protect the bottom line and what's best for the corporation and the shareholder.
Yeah. So that's my argument for next year is a lot of the Fortune 500s haven't made the moves. And if you're looking to the best and brightest, like let's just say that the best minds are at the top. Okay. And I know that's like you alluded to it, right? It's an unpopular opinion that the top companies should be at the top. But guess what? They're the best. That's just why that's why they're there. Now, does it mean they're never going to make mistakes? No. They're going to make mistakes. They're going to have issues. There's going to be corrections. That's all true. And I'm not saying they're perfect, but they're at the top for the reason. Their company's market cap is big because they've made a lot of good decisions over the years, right?
Yep.
Now, let's assume for a second that the second tier of management is at the mid caps and the small caps. That's just the reality. That's just how it works. There's a reason why the top companies pay their CEOs $300 million a year and the small caps don't. Okay. So if you want to look into the future, look at what big tech's done. They've done layoffs, like you said, right? They've done cost cutting measures. They're trimming back a little bit. What are they doing? They're doomsday prepping, just like a lot of people out there, right? People like you and I. Mm-hmm. They're preparing for a rainy day. They've done their doomsday prepping. They've done all that hard work. And I think now, guess who's going to catch up? The small and mids. The small and mids are going to say, all the stuff that big tech did, we're not getting to choose to do this stuff. We have to. And it's not a good thing for the economy. There are going to be layoffs, but at the same time, don't expect this doom and gloom in the market where the market drops 50%. I just don't think that's going to happen. In fact, what I think you're going to see alternatively is small and mid cap do poorly again next year. Large cap continue pushing the market forward, and the big stocks, those 7 or 8, you know, Magnificent Seven, or some people even include the 8th stock. What's the 8th one? I can't remember.
I think it's Berkshire, isn't it?
Maybe Berkshire or something like that. Those 8 stocks, I believe, next year continue to power the market forward.
All right, let's I think that's a great take there. Let's we're gonna drop the last one. It was if you hadn't seen it, Snoop Dogg was going smokeless.
DOGG.
Everybody started freaking out for whatever reason because they obviously thought that wasn't possible. And I remember I said to people in the office, not to say I'm always right, but I go, there's no way this guy is done. This has got to, there's something. All he said, oh, I'm going smokeless. There's no way he doesn't just have a separation like that and leave it at that, right? So
did you see the tweet where he has the hands?
Yeah.
And the tweet says, after much consideration and conversation with my family, I decided to give up smoke. Please respect my privacy at this time. And that's signed Snoop Dogg. And then this is the best part. The community notes. Did you read the community notes?
No, I didn't. I love community notes.
It says, this is a marketing stunt for a smokeless fire pit.
Which, honestly, those are great. You got a solo stove.
I love it.
I'll throw a quick plug out. Hey, if you want some people to, plug your product, you got 2 of them right here. We'll talk about it.
Well,
it's
do you
great.
want the unfiltered review on Solo Stove?
Sure.
Do we have time? Okay, real quick. I'll give it real quick. Okay. Overall, great product. I would recommend it. Don't get the medium size. We have the medium size. I'd get the large one. That would
The
be
Bonfire.
I don't know.
I think that's the big one. Yeah.
Okay. Well,
No, the Yukon. The Yukon is the way to go. We have the Bonfire. It's fine.
it's okay.
But it's too small.
No, you need the Yukon. Okay,
Yep.
now very easy to start a fire, but it's never going to have the same effect as your classic fire pit. As far as like if you're sitting way back, like I would say
You got to get a heat deflector.
Yeah, but like, that's how they make their money. I get it okay. But like I'm going to spend $400 on a bonfire and then also have to buy a heat deflector and then
that's $150.
Buy the like holders for it. And then if you're sitting in the middle, Bond has the heat deflector, by the way. So
it does work. Yeah,
it works. But if you're sitting in the middle and you don't have that, I would say if you're at the corner of this room, you wouldn't be able to feel it.
Yeah. It is nice being smokeless, but you definitely don't get the same heat that you get from normal bonfires.
Much easier to start a bonfire, though. So if you're looking for a quick, easy, you and your wife just want to have a bonfire on a Tuesday night, it's a great product.
Yeah. And the new ones, you can take the ash out of the bottom much easier.
Oh, really?
Yes.
Okay.
That's an issue I have with mine.
That's a huge issue.
They listened to the people and they made adjustments. Maybe this is the 3.0. We might have to try it out. See what Snoop was, why Snoop was plugging it.
Yeah. Well, anyways, Snoop Dogg, D-O-double-G.
Yeah, the D-O-double-G, going smokeless for fireplaces. Okay. Let's run through the charts real quick here. First one, we hope, I didn't even wish everybody, we hope you had a happy Thanksgiving.
Happy Thanksgiving.
We hope you had a wonderful Thanksgiving. Average cost came down. It had, we talked about this, right? You talked about, it's transitory and inflation's transitory. Now it was up 13%. We saw that in the cost of a Thanksgiving meal. Finally, maybe a little bit of help to the average American's pockets for this season.
Yeah, I think I think as far as inflation's concerned, look, we've put the chart. You could put any chart of price increases the past 3 years, literally right next to the chart of M2 money supply.
Yeah,
the supply of money's gone up 40%. How much is this up? 50 to like 62, 63.
Yeah,
that's about right. About 40%. So the reality is that, well, that's not quite 40%, but the broad CPI trend is 40%. Money supply has gone up 40%. It just goes to prove you print dollars in the economy, the dollar becomes worth less. It's not rocket science. Now, I would argue that most of the price increases are behind us. So you going from the sandwich, being, $15 to 18 or 20, it's probably not going from 20 to 30 anytime soon. But I think the bigger question is, are you going to continue to see this drop? I would say no, unless we hit recession. If we hit recession, that comes way back down.
Yeah.
It doesn't come down to the 50 level like it was in 2020. But I think what it does do is it just reduces ever so slightly because you're getting money pulled out of the system. The Fed is still shrinking its balance sheet. They say they may raise rates again.
I think Jerome's just trying to be, or Jay Powell is trying to be a little bit, he's got to stay hawkish because the minute he says, oh yeah, things are great, to the moon.
Yeah. Well, did you see the video of him telling when they had the protesters in the Fed meeting?
This is the first time I do remember that.
He said, close the effing door.
Oh yeah. A little hot mic moment for our friend Jay Powell. Maybe one of the best things he said. I don't know. I mean, don't take my word for it.
Yeah, I think people enjoyed that. Anyways, but yeah, this is not.
He let loose a little, which I think is the only thing that people really got enjoyment out of that.
I'm surprised the Biden administration is not. Have they tweeted about this? Because they did. Remember they talked about the 4th of July barbecue.
Well, Kamala Harris. Did you see she posted a picture of she and her husband making Thanksgiving meal and they had a gas stove in the back? And remember for the green stuff, they're trying to get rid of gas stoves. So I saw people.
What's the big deal with gas stoves?
I have no idea.
Are you telling me if I have my stove on, I'm going to pollute the world worse than China? Now, I don't cook a whole lot, so it's not me.
All right, since we're talking about it, I'm jumping to the next chart so that we get off that topic. S&P 500, looking at 4-year presidential election cycles. I know this was something that you sent me. Shout out to JC. Is it Parrots?
I think it's Parrots.
Yeah, JC Parrots at All Star Charts.
We love you, JC.
Yeah, he's got some great stuff that he puts out from a behavioral standpoint.
Yeah.
Right. Typically year 3 is usually the best historically from a performance standpoint, but year 4 is still net positive generally. So I don't know. I know you wanted to talk about this one.
Yeah, this is a great chart. So, typically in these cycles, and I think JC's point is well taken, that everybody's surprised by the performance this year. But in reality, you have two things going on. And I don't think it's just the election cycle. I think it's one, you're coming off of extremely low return last year. Like, market was down 22%. So again, a forward-looking indicator. The market said two things. Rates are going up in 2023. They did. And recession. Rates went up, but recession never happened.
Mm-hmm.
Okay. And I think that's the fact. Now, take it even a step further and you say, okay, why does the market go down in the second year? I think their answer maybe not always go down, but it looks like on last year it stayed, or the last cycle it stayed like kind of even.
Yeah.
You've got uncertainty around the midterms because the midterm cycle and the presidential cycle are off by 2 years. So I think that's what it is. If you get the most crazy ideas passed in Washington, the market gets really nervous, whether it's left or right. If you get exactly what you want through and you don't have any pushback, that's when the market panics. That's what you see in the midterm year. When you get that gridlock in Washington, the market kind of has a sigh of relief, says, okay, things aren't going to be that bad. We know what to expect. Market takes back off. That's the third year. The fourth year is interesting to me. I think it's probably because the sitting president usually loses the support in Congress if they get reelected. That's pretty typical.
So there's a little bit more certainty built into what's kind of historically happened from an election standpoint, is what you're saying.
Right. Like you saw this with not just Trump, but even Obama. You saw it with Obama's second term. He lost Congress. By the time it was his last 2 years in office, so out of his 8, his last 2 in office, he was basically a lame duck president. Everything was executive orders. It was pretty much ceremonial in nature. He wasn't getting tax hikes passed. He wasn't getting he had some regulation in the last 2 years, but it wasn't this massive spike up like you saw in the first 6. Mm-hmm. So the market, again, breathes a sigh of relief. Same thing with Trump. Okay. You saw Trump after his first 2 years, he lost Congress. And in the last 2 years, he got some stuff done. He got some stuff passed, but it wasn't this massive radical change. And I think that's exactly what happened to Biden. I think you're going to see it again in this next cycle. And again, I'm not rooting for any side, but I do think what you're going to see in this next cycle is whatever happens on the presidential side of things. I do think you're going to see Republicans take back more control of the House and the Senate. And that, effectively makes the Democrats ineffective when it comes to policy at the executive level. So that's what the market's saying. The market's saying we love gridlock.
All right. Next one here, home purchases have fallen through now at the highest rate on record in October. So if you look back at the last 7 years, average has probably been 12.5%, 13%. And now we're looking at them falling through at about 16.5% or 17% roughly. So, obviously mortgage rates. And I know we actually talked about this earlier this week. And you kind of have a theory to some extent based on conversations you've had with some of your realtor buddies, but I'll let you take it from there.
Yeah. I don't have a ton to say about this other than the fact that I have seen it on a very micro level in Naperville. That's where I live. And, for all of you who don't know, and Naperville gives you
we never talk about it.
It gives you a decent representation of what's out there because you do have, you have over 150,000 people. You've got a probably higher average household income, and you have at least downtown Naperville, you have a higher average purchase price point, right, than the rest of the country. So you get an idea for what's going on. I've seen this, especially in the luxury market. So once you hit that 1.5, 1.6, it used to be $1 million. But now once you hit that $1.5, $1.6 million price point, almost, I wouldn't say all the deals are falling through, but a good amount are falling through. And I think it's the banks. The banks just are saying, this is what I've heard from people on the ground. They say the banks at the last second pull out of the deal or they don't make the loan available. So you can get a pre-approval letter, but then you go to finance the loan and they're like, oh, sorry, we're not going to do it. JP Morgan was one of the best risk managers during COVID. Jamie Dimon said, we're not going to make a lot of the loans that Bank of America is going to make. And look at where the two stocks are now. Yeah. We talk about Bank of America. I don't think there's a viability problem yet there, But certainly there's more of an issue with Bank of America than there is with JP Morgan. JP Morgan is the fortress balance sheet. Not to say it's never going to have problems, but I do think, I think now the banks are saying, okay, our capital is lower. I think banks are preparing for this Basel III endgame. I don't know if you've read anything about that, where the regulations will get more stringent on banks, but they're preparing for it.
Yeah.
So I think the housing market's got a lot of problems. So you and I have talked about this quite a bit.
But the difference too, and I know I read a great article. It was 2 weeks ago, and it was talking about this housing market. Everybody goes back to whatever the last issue was, right? So that you think 08, 09, where everyone and their mother could get one loan, two loans. They had multiple homes in different areas. There wasn't this pre-approval process that was as stringent as it is now. So it's not like this is the issue, right? Because they're almost being so tight-fisted that they won't let loans out,
right?
But it compares it more to the 70s, when we had this high interest rate environment where all of a sudden mortgages doubled. Now back then they were like 17-18% coming off of 8 or 9. Yeah. And home prices were at a different place than they are now, but that's kind of what it was comparing it to from that perspective. And then all of a sudden you get a little bit of the Fed stops the cycle. Maybe they cut rates at some point, and now you're looking at people at 4 or 5% mortgages again. 5.5, 6, let's say, and that's when you see with averages, right. And that's when you see people start buying again. But everybody wants to compare this to 08 and 09 because it's the freshest in memory and what everybody's dealt with. When in reality, there's not necessarily a ton of parallels, which I think, to your point, conversations you've had, loans not coming from banks, is in line with that.
Well, and the other thing you have is people have this, you're talking about this, but the recency bias of 2.5 to 3%. My mortgage was 2.5%, not to brag, but it was 2.5%.
Yeah, mine's 2.8. Not to brag either.
Are you going to move anytime soon?
It depends on who gets their way. But we won't get into that. We'll be here for another hour.
We'll bring Eden in next week as a special guest.
Oh, geez.
No, but look, the reality is nobody with the 2.5% mortgage is moving unless they absolutely have to.
Yeah.
But if you go back prior to COVID, you go back to 2019, 2018, 2017, I have clients I know for a fact they had 5, 6, 7% mortgages and nobody cared. They were fine. Some people were refining on the way down. I had a client who refied from 7 to 5 to 4. And then during COVID, they went to 3.
Yeah.
So the bigger problem to me is not the cost of the home. And if you actually go back to the 70s, when everybody talks about, okay, boomer, your house was $50,000 and now the houses are $400,000. But the incomes were dramatically different. Incomes in 1970 were a couple $1,000s a year. So if you actually take the home price divided by annual income, it's about the same as it is today. Your median household income is what? 70, 80,000. Average home price is about 400. That's roughly in line with the numbers from the 70s and the 80s. So it's not necessarily an issue of housing price. My bigger concern is there's just no supply. And you have Uncle Sam to thank for that. You have the government coming out of 08 and 09, where they got overly stringent, overly tight on building permits and allowing banks to lend. And that's created the shortage we have today. Central planning, government, centralized control, making regulations always leads to shortages. We just haven't felt it until recently.
Well, yeah. And that was the 70s was when the boomers were coming out and it was their peak buying years. Now we're looking at, this is millennials' peak buying years, so that's another parallel that they made between the 70s and now. So yeah, I mean, definitely something to keep an eye on. I read another article that was talking about how a lot of homes coming for sale now, and this is another thing people don't talk about, 40% of homes are just paid for in cash at this point. People are just, they've built up wealth, they have savings, rather than even having to deal with a mortgage. They just pay, they just buy it straight up, which is a great thing from, each individual's kind of wealth standpoint. But
what's your perspective on your friends? And we're basically in the same, bucket here, but what's your perspective on your friends buying homes? Do you still have friends renting? Are they actively looking? What's the mix?
Yeah, I mean, it's probably 50-50 between people who own And that's the thing too. Not everybody, like my wife and I, we didn't buy our house in COVID. We bought it in 2019. We were at like 4.5, I think, when we initially bought, and then we refied on the way down, and then locked in, basically 287. It's 2875 for 30 years. But a lot of our friends, they moved kind of in there. Not as many bought as early as we did, but I mean, we're probably 50-50. Some still rent. It
Some
just kind
people
of
downtown
depends on,
renting and
yeah,
yeah.
yeah, because buying downtown's brutal too.
Oh, you cannot buy a home in a city between the HOA, the taxes, and now the interest payments. You'd be insane to buy something in a major U.S. city.
Yeah, but
Not,
all my closest friends own.
I
At
mean,
this
even
point.
like Houston, like I was just looking because I know the area pretty well now with our Exxon people and all the rest of it. The HOAs are like 1,000, 1,500 a month, 2,000 a month because I wanted to see the difference and see if there was a big difference. There's not. I mean, Chicago is obviously like one of the biggest culprits of the HOAs and all the rest of it to deal with the regulation, quite frankly. But I mean, there's not this massive difference. I think you go almost any city, and if you're in a highly concentrated condo building, you're looking at $1,000 a month HOA.
Yeah, which is crazy when you get into it from a rental standpoint. So, all right, let's talk GM and Ford. I know this is one we've kind of talked about a little bit. This is another one from our friend JC. But this is, there's been conversation about who's going to be around on the car side of things. And Ford and GM, from a stock standpoint, from doing what's best for the shareholder, have not done what is best. I looked it up right before this. There have been a couple articles that came out in October talking about this. Ford, on their balance sheet, they actually separated, or their earnings statement. They lost $1.3 billion in Q3 alone on EVs.
Wow.
GM lost $1.5 billion in Q3. Now they don't separate it out, but still negative $1.5 billion.
Do you think the issue is solely EV related? Do you think that's the problem? Like, do you think if they didn't do the EV push, they'd be okay right now?
Well, I mean, that's what they're losing. Think about all the money that they used to ramp up that side of things. Certainly everybody was hurt in COVID as well from supply chain issues. You had chips, going back to NVIDIA, like a lot of their business as well comes from chips for cars. You had shortages there, and that created issues across the board. But I mean, it was, if you take that $1.3 billion, it's like $60,000 a car in losses for a number of EVs sold.
Yeah.
So directly tied to that.
So it's either the EV push isn't working out, like there's just not enough demand outside of Tesla for EVs. That's number one, or Tesla's just so far ahead of the pack. When people go and they say, okay, I'm kind of considering an EV, they just don't even think Ford or GM. They just think automatically, I'll get a Tesla.
Yeah, and that could be it. Not to mention Tesla's at the point where they can price a lot more competitively right now, and Ford and GM can try.
Yeah.
But those are just straight losses on the balance sheet for them because they had to ramp up these last few years, whereas Tesla kind of laid the groundwork. Tesla wasn't this great stock. Remember? I mean, think about all the mounting losses that they were facing and issues getting the Gigafactory up and all that. It's not like they've been this, monster this whole time. They laid the groundwork years before anybody else did. That's the biggest thing.
They ate their lunch when it came to EVs.
Yeah.
Yeah.
So I don't know. I mean, maybe they should be staying in their lane. I mean, when I think truck, I think F-150. Those GMC Sierras are nice too, if you talk about GM. But I think like, if I wanted to go out right now and buy a truck, I'm probably getting an F-150. If I can, I'm getting a Raptor because those things are awesome. But that's what I think. I want an internal combustion engine.
I do too. I mean, I would say probably out of the two of them, Ford probably makes it. Like, I don't know if Ford goes under, but I think GM, they've already gone under before and gotten bailed out. There's a shot. Like, I don't short stuff in my portfolio. I don't believe in leverage and stuff like that. But if you do, and again, not investment advice, but that's the one to short, GM.
But I mean, how much does it really have on the way down at this point?
A lot of people joke that GM is government motors, it's like,
because they had to bail them out.
GM is the DMV of car companies. And you ask how much lower could it go? It could go a lot lower. I mean, it could go to 0,
Yeah. What's it at now?
28 a share.
Yeah.
It's right kind of.
Yeah, on the right-hand side there.
So, all right, you want to move on?
All right, yeah, let's do the last one. This is our L of the week. Come on, baby. All right, so let's just run through some of the calls that have been made. Q2 2023, S&P is going to 3,900. And this is when it was trading at 43.
For some context, now this is Mike Wilson, who is the chief market strategist at Morgan Stanley. Not saying anything bad about Morgan Stanley, just pointing out his particular calls. He's not the only bearish guy, but the reason we're pointing him out is he was heralded as the main guy in 2022 to call the the bear market of 2022.
Yeah.
Right. I kept saying long before that, I said, well, yeah, just because he called 2022 doesn't mean anything. You have to go back even further. If you looked at all of his calls from like 2010, 11, 12, 13, 14, 15, you would have never made any money. So to us, this chart isn't a huge surprise because I had seen this happen years and years and years before that.
Yeah.
So again, nothing about the company he works for. It's just mostly the fact that he's a strategist. And I try to talk about this on my show all the time is there's a massive difference between strategists over here who don't manage money and they can say whatever they want on CNBC. Everybody forgets about it and they come back on the next week and nobody says anything like, hey, what about this call you made last week?
Except bar chart.
Except for
they put them on full blast.
Versus portfolio managers, people that actually manage money that have to produce a report card and they have to say, here's how we've done. And when you get down to it, the people that are portfolio managers, in my opinion, those are the ones you want to listen to.
Well, and this isn't even coming from us. I remember reading something a couple of weeks ago comparing him to Jim Cramer being being a contraindicator for things. So I mean, that's really what it is. Market's trading at 4,300. It's going down to 3,900. Then things go well. It's a buy at 4,600. Then it drops from 4,600. Then end of October, beginning of October, we see him say, I could go down another 25% from here when it's trading at 4,200. And then from that point, it went down a little bit further, to be fair. But then there's going to be no year-end rally. That was at, 4,150. And we're now trading above 4,300, or I mean, we're way above it at that point,
like almost 4,600. But I think the craziest thing here, the most shocking to me, like I knew he would be bearish going in the year, and he said that the year end was going to be 3,900.
Yeah,
so I knew that. The one I was most shocked about was when he came out at 4,600 this summer and said that the market would keep going up higher. That one I truly was surprised.
Yeah.
So, anyways.
All right. Well, let's do quick 0 or to the moon. The one that I picked for this week is Birkenstock. And really the only reason I brought it up was because I wanted to figure out, are you are you a cross toe sandal guy? You a thong sandal kind of guy?
I don't like you calling them thongs, but
no, I just like making you feel uncomfortable sometimes. I will say Olakai's great. Now, doing an independent analysis of this, and again, no, it's not.
Are you sure?
Like tongs, like you use for the grill?
That's what I thought it was.
No, it's not that. I don't think it. I could be wrong.
Well, I've been calling these
Feel free to
the thongs.
Oh, you have?
Yeah.
Jamie, have you seen my thong? I'm going out to the grill.
Okay, Birkenstocks. I get. You told me. I know this because you told me your wife.
Not stock advice.
I hate Birkenstocks, but I guess people like them nowadays.
There's a lot of people who buy them. They're a 250-year-old company. They just IPO'd, right? So they IPO'd earlier in the year.
How much do they cost for one pair?
Like $100, $90.
So they're like overpriced Crocs.
Well, but they're better because they've got the cork footbed. They're very comfortable. I personally,
that looks like a Croc with leather on it.
No, but they all don't look like that. This is their thing. They've got a vertical supply chain. It's all for the footbed. That's the base. That's what they build everything off of. And then you have lots of shoe designs off of that. My wife's got like 5 pairs. I own a couple. I've owned a couple throughout time. Producer Owen, he owns a couple.
Really? How many pairs?
I just got one.
Okay. All right. Well, fact check me. All right. So you're
willing to stake your reputation on Birkenstock going to the moon?
Okay, this is what I was going to say. The IPO to try and take care of a debt problem,
Oh, interesting.
to pay down some debt.
Okay.
And contingent on that, I think they could do what, like, I pulled up, some other things over time. You got Crocs, and you
Crocs done well,
have
right?
Steve Madden. OnCloud has not done well since it IPO'd about a year and a half ago. But you look at oh man, what's the other one? You've got forgive me, you have Beck, which owns like UGG Decker. Sorry, you have Deck. DECK is the ticker on that. They own UGG. They own a couple of other big brands. I mean, overall, over time, if you look at the last 10 years, the stocks have done well.
So you could have bought Crocs after 08 and 09 for $1.50 a share. It's almost $100.
Yeah.
That's wild. That's wild.
And part of it is you catch a trend, like everybody wears the white Crocs now.
Right.
But
you nobody wanted them for the longest time.
Yeah.
They were the weird. They were like, only weirdos would wear Crocs, but now they're cool.
And maybe this is a terrible kind of first one to go over on my end from zero or to the moon. I don't know. Do I really think a shoe company that has one footbed that they build everything around is going to the moon?
It's pretty smart, actually, the way they do that.
But they've built a great brand, and as
Yeah.
long as they can take care of some of the debt, then
Do they have a lot of debt still?
not a ton. I mean, when they IPO'd, I think there was like 450 million that they were trying to get rid of.
Okay.
And they said part of it was servicing some of that. So
You know
we'll
what?
check back. It's done fine since it's IPO'd. It's positive.
You know what, Sam? I'll buy one share. One share.
And just for everybody out there to know, Nick is buying this one share because in a year he's going to come to me and be like, dude, I can't believe you said to buy Birkenstock. That's the most garbage stock I've ever seen in my whole entire life. Right or wrong?
Yes, that's exactly correct. Every episode of Bullish from now on, whatever you say is going to the moon, I'm buying one share.
All right.
Just so in a year I can see how it did.
And you're going to do the same for yours as well, correct?
To be determined.
I will say, I really just picked that one because they IPO'd. So we're kind of starting from zero to some extent. And because I wanted to ask you an uncomfortable question, if you wear thongs. So
I do not wear thongs, just to put it out there.
All right, let's get into yours.
All right. What are we doing? In mode?
Yep.
Pull it up. I think this is a great company. Again, none of this is investment advice, so don't do anything we're saying. But InMode operates in the space of basically minimally invasive plastic surgery. So your options with plastic surgery are you go under a knife, you get general anesthesia, so you go under, and they slice you up, but it's a long recovery process. Then there's laser. So laser is not invasive. It's just, zapping your hair or whatever, whatever you're trying to get rid of. But laser doesn't really do a whole lot. Like it's
not as effective.
No, you're not going to contour your body with laser. You're not going to do like a lot of these procedures. So InMode invented these machines and this technology where it's a mix between non-invasive and super invasive, which is going under an actual knife. So it's kind of in the middle.
Yeah.
And they've been very successful.
And it's just local anesthesia, correct?
Yeah, you stay awake the whole time, usually outpatient. So you go home the same day. It's at the clinic, the doctor's clinic.
Yep.
The machines cost about $60,000 to $80,000. So a doctor will typically buy maybe 2 or 3 or sometimes 100,000, but the doctor will buy maybe 1 machine, 2 machines. They've got different machines for different things.
Yep.
And then finance that. So it's really been hurt recently. It's down about it traded for about 95 a share during COVID. It's down about 75% from its all-time high, but it's still up. If you look at the past, since it IPO'd right around $7 or $8, $10. Now it's trading at 23. So it's still done well over that time frame. It's trading down, in my opinion, because of interest rates, because that's hurting their sales with doctors.
Because they can't finance the purchase of the machines.
Yeah, so that's the bear case.
Yeah.
The bull case is that all the weight loss drugs out there, that's clearly a trend. Like Pfizer's coming out with one. Eli Lilly's capitalized on theirs. Ozempic
is kind of the headliner on that.
Right. So now this isn't me saying this. This is their management team. So take it with a grain of salt. But what they're saying is there's a direct correlation between plastic surgery and then people losing weight, because they're losing weight, they're feeling better, they're looking better, but it still doesn't remove a lot of the old skin, a lot of the, the look that people are trying to go for.
Mm-hmm.
So they're pairing Ozempic or some of these weight loss drugs with body contouring. So they think that's kind of the bulls for it. So.
All right.
Yeah.
All right. Well, I guess you have to buy a share of that too to keep track of it, but
I've got a few shares.
Yeah. Well, yeah, I do too already. So we can keep an eye on that one. But remember, if you like today's content, you like the new structure that we've got, be sure to like, subscribe, share with people who you might think appreciate it. If you'd like to learn more about Stenger Family Office, visit the website or give us a call at 630-912-8431 to request your complimentary starter kit. You can start a relationship with us with $1,000 starter account. Remember, that's just $10 a year in fees, actually. So we appreciate you listening. We're going to be getting these out more regularly now, especially in the studio here. So looking forward to that. And again, appreciate you joining us for this week.